In this lecture, we're going to be talking about corporate income taxes. That's one of our favorite subjects because nobody likes to pay taxes, least of all to the federal government. Taxes are an important part of the cash flow, and we need to be able to calculate them properly. We will first talk about the different types of taxes, the many different ways that government jurisdictions levy taxes, and then we will focus on the corporate income tax for U.S. corporations. We will define operating income, and then move on to the graduated tax structure, which is currently in effect in the United States. We will finish with a formula-based computation, which most people use to overcome some of the intricacies of the graduated tax structure. Let's see how many different ways that there are that governments might tax you. At the top of the list is an asset-based tax, which is usually a percent of the asset value. If you're a homeowner, you might be taxed perhaps around the 1% level on the value of your home each year. Many states apply asset-based taxes to your automobiles. That's called ad valorem tax in most jurisdictions. Many centuries ago, the head count tax was very popular with royalty. And in this country, it wasn't too long ago that we had poll taxes. That's another form of a head count tax. Excise taxes are measured in dollars per unit produced or sold. Sales taxes are usually levied by local jurisdictions on the percent of dollar sales. Many times, local jurisdictions use the sales tax not only for general operations, but also for special purposes, such as rapid transit. Capital gain taxes are levied on the percent increase in the value of an asset when it's sold. In the United States currently, many people enjoy an exclusion from the capital gain tax once in their lifetime on their primary residence. And last we come to the income tax. That's the percent on the difference between revenues and expenses, and that will be the main subject of this lecture. Here we define operating income to be the difference between revenues and expenses. So let's see which elements are included in revenues and which ones are allowed as expenses. First we have revenues from goods and services. That's the primary revenue generator for manufacturing companies. We may also have revenue from rents, renting property or renting buildings and so forth. If you're a high technology firm, then you might generate revenue from license fees for patents. Interest earned on accounts is also revenue, as well as our dividends received from another company. Almost everything that a company spends money on is allowed as a deductible item, especially salaries and wages. That's usually one of the major components. Salaries to your monthly employees, wages to your hourly employees. Commissions paid to sales agents, sometimes percentage commissions or bonuses. All these are legitimate expenses. Raw materials and work-in-process components that are bought from other companies are also included. Rent and lease payments. Interest paid on loans normally is allowable. Advertising, insurance, a long list of different types of items. Perhaps the only types of items that are not allowed are bribes paid to different people, whether they're government officials or private persons, and certain types of judicial penalty payments. So how much is the tax? Well, here we have a long table that has 8 ranges or 8 brackets. A small company that has a small taxable income, let's say in the range from $1 to $50,000, pays a relatively low rate of 15%. If a company has a taxable income in the second bracket, from $50,000 to $75,000, then the first portion, the $50,000, is taxed at 15%. The next portion, the portion that falls in the $50,000 to $75,000 bracket, is taxed at 25%. So 2 different tax rates are applied in that situation. The third bracket, 75 to 100, is taxed at 34%. And so it continues. And we see the numbers increasing, going up from 15 to 25 to 34, 39. You might think, well, are they continuing to increase? Well, no, they actually go down again to 34, goes up a little bit to 35, up to 38, and eventually it levels off at 35%. This is a rather unusual tax bracket situation. In most industrialized countries, we might see 2 or 3 or perhaps 4 brackets. And normally these rates would increase monotonically, starting at a low value, perhaps 10 or 15%, maybe topping out at 30, 35, or 40, in some countries perhaps 50%. This business of jumping around is a quirk of the United States tax law, and it's just something that we have currently in operation. Here we see graphically the same situation. A small company might be operating down here in this first segment, where the slope of the graph is 15%. We see on the horizontal axis the taxable income. We call that operating income in this lecture. And on the vertical axis, we see the total federal tax. As the total taxable income increases, the slope on each segment is increasing for these first four brackets. It goes from 15 to 25 to 34 and then 39%. So a company that earns exactly $335,000 taxable income will then pay a total tax of $113,900. We have to change the scale for the larger firms because in this small portion of the graph down here, we're actually compressing the first four ranges. Then range 5, or bracket 5, is this range from $335,000 to $10 million, where the slope of the graph is 34%. From 10 to 15 million, the slope is 35. Then it goes to 38, and beyond 18,333,000, the slope is 35%. Let's look at an example of a small company that might have a revenue of $450,000, different types of cash operating expenses. Cash operating expenses are those which are normally paid within a short time of the expense being incurred, let's say a week or 2 weeks after the expense is recognized. Labor, $120,000, materials, $35,000, rent, $22,000, insurance, $15,000, total expenses, $192,000. We subtract the total expenses from our revenue of $450,000 and get an operating income of $258,000. The federal tax on that operating income is $83,870. We subtract that tax from the operating income, and that leaves us with a profit after tax of $174,130. Let's see how the federal tax is computed in this example. We first see that the $50,000 income in the first bracket, taxed at 15%, leads to a tax component of $7,500. The next $25,000 in income is taxed at 25%. That tax is $6,250. The third bracket, $25,000, taxed at 34%, leads to $8,500, and that portion of the income which is above $100,000, remember our total taxable income is $258,000. The first three brackets add up to $100,000. That leaves $158,000 taxed at 39% for a total of $61,620 in range 4. The total tax is $83,870. There's another way to look at this, and that is to go back to our very long table where we see that the tax in the first bracket, up to $50,000, is taxed at 15%. A company that earns exactly $50,000 would then pay $7,500. A company that has a taxable income above the lower limit of $50,000, but below this limit of $75,000, will then pay $7,500 plus any excess in this range at 25%. A company that finds itself in range 3, between the limits of $75,000 and $100,000, would pay $13,500 plus 34% on the excess above $75,000. So we can use our company, which is operating in range 4, the $22,250 is the sum total of the tax of the first three ranges, and then simply apply the 39% on that amount, which is above $100,000. So we show the rest of the table here. This would apply for larger corporations, and we can apply this method for any corporation. Here is a recap of the shortcut method. We're showing ranges 1 through 3 that are adding up to a total tax of $22,250. The difference between $100,000 and the operating income of $258, that's $158,000, is 39%. That adds up to a total of $83,870. We call this the formula-based approach, and it's the approach that most people use for computing corporate income taxes. So here we have a summary of what we have covered in this lecture. We discussed the many different types of taxes that jurisdictions might levy on corporations. We also focused on the corporate income tax. That's usually the major component. We defined operating income to be the difference between revenues minus expenses, and we discussed the different types of items that might go into revenue and those that might go into expenses. And then we took a close look at the graduated tax structure, which in a rather unusual situation has 8 ranges where the tax rates are not increasing monotonically. They have a tendency to increase, but they do jump around a little bit. And then we finished with a formula-based approach that most accountants would use to compute the corporate income tax.